This is the Weekly Outlook here at xm.com. Thanks for joining us. I'm Christina Marujos, and with me today is Senior Investment Analyst Mario Hadjikyriacos. We'll be having a look at the most important events of the upcoming week. Marios, let's start by having a look at Japan because the Bank of Japan meets on Tuesday. Markets, though, are not expecting any significant changes to policy. However, what would that mean for the yen, especially when other major central banks start raising interest rates?
Hello, Christina. I doubt it's going to be an exciting meeting. There hasn't been an exciting Bank of Japan meeting in 3 or 4 years now. That being said, it's going to be pretty interesting to see how they balance the recent signs that the economy is doing better against the overall gloomy picture. So let me explain what I mean by that. We've seen some pretty encouraging signs in Japan lately. Businesses are turning more optimistic. The unemployment rate is at 2.2%. We've escaped deflation and exports are doing better now that the yen is weaker. Now, all of that sounds good, but I don't expect the Bank of Japan to signal, rate hikes are coming or anything similar. Why? Consumption remains very weak. Household spending is negative from a year ago. Wage growth is still pretty subdued despite the tightness in the labor market. And of course, we've got Omicron. It's really sweeping through Japan right now, and that's a major threat to the recovery. So we're doing better, but we're not out of the woods just yet. And the inflation rate just speaks for itself, right? It's barely positive despite all of the supply disruptions and the soaring energy prices. So that tells us that organic inflationary pressures in the economy are still pretty weak. Now, what does all of this mean? We're probably going to get a little bit of a more optimistic tone from the Bank of Japan next week, but nothing dramatic, right? They're not going to signal any policy changes. Indeed, it might actually take years before they even consider raising interest rates. Now, for the yen, all of that suggests that the outlook is still negative. The Bank of Japan is not going to raise interest rates. Many other major central banks, the Fed, the Bank of England, are going to raise interest rates moving forward. So relative monetary policy argues for a negative outlook in the yen. Here's the caveat, though, what might rescue the yen, if you will. We've got the government and it's preparing to unleash a massive spending package. Besides that, and of course that could help the recovery, right? And besides that, we've got this really shaky environment in global markets right now. Stock markets are very volatile. You see a risk aversion everywhere. And if that continues, that could allow, if volatility episodes like this become more frequent, that could allow the yen to enjoy brief periods of strength, given that it's a safe haven currency. So the trend might be negative, but I think we're going to get a very bumpy ride lower, if that makes sense.
Now let's cross into China because the People's Bank of China meets this week on Thursday to be exact. But before that, we'll get the all-important Q4 GDP report of the country out on Monday. Could that possibly tip the scales in what policymakers might signal on Thursday?
Very possibly. So let's start with the GDP numbers. We're expecting pretty bad news. So growth is expected to have slowed from 4.9% down to 3.6%. That's a pretty dramatic slowdown for a powerhouse like China. And if that's the case, if we get pretty weak GDP numbers on Monday, I think that's going to give the People's Bank of China the perfect excuse to loosen policy when it meets on Thursday, either by cutting the reserve requirements for banks again or by lowering the actual policy rate. Now, what does all of this mean? I think we could get a case of bad news is good news, right? Because if GDP numbers are weak, that means more policy is coming, which might actually help stabilize the economy. Now, for the markets, what the People's Bank of China does is usually not very important. For the Forex market, it's usually not extremely important, but it does affect local stock markets in China. Now, that being said, we could see some effects on the Australian dollar, of course, which is very sensitive to any China developments. Now, the Aussie is doing pretty well actually lately. It has staged a pretty decent recovery on the back of recovering iron ore prices. Now, of course, I think this is still the outlook for the Aussie is still pretty shaky. The markets are pricing in 4 rate increases from the Reserve Bank of Australia this year. I think that's over optimistic. We might get one or two. I struggle to see four, simply because the Australian economy is not that strong, and you also have the risk of spillover effects from China slowing down.
Marios, it was great having you with me today. This was the Weekly Outlook here at XM.com.